My name's Ola Brown, and I run HealthCap Africa, which is a venture capital firm that invests in pre-Series A health tech and fintech companies.
Hello. Hi, I'm Hiba Hai. I am the managing director for Liwa Egypt. Our company is an SME lender that is tech-enabled. We are currently present in Jordan and in Egypt.
Hi, my name is Martijn Woudscha. I'm heading the FMO Ventures program. We're deploying a 200 million facility for Asia and Africa in direct and indirect investments in venture. And I'm actually heading the team only for 6 months, I must say. So I'm a VC tourist. In regular life, I was a traditional PE investor.
Hi, Greg, partner Orange Ventures, a 15 million euro fund from seed to Series A.
Awesome, great. So as you can see, we have a good combination of VC, corporate VC, PE, and an entrepreneur. So we want to get to the essence of really how do you determine the difference between PE and VC and what's actually needed at what stage. And I just want to start by asking the panelists, what do you think is the most common misconception of either VC or PE? So Ola, you can speak to VC. What's the most common misconception?
I think that VC is about vibes and PE is the serious one. As a proportion in terms of the global source of markets, obviously PE commands a lot more in terms of money allocated to the asset class than VC. But VC punches above its weight. So if you look at proportion of new IPOs in the American market, for example, if you look at net new jobs, then you can see despite the tiny amounts that we get allocated as an asset class, we're still able to produce a lot of new jobs, a lot of new IPOs, and a lot of innovation. So I think, yeah, the vibes reputation of VC is understood. There's actually something behind it.
Fantastic. And Haki, what about you? So you've had VCs invest in your business. What's a misconception internally that people think? What do they think a VC is going to come do in the business?
I guess maybe I would say some VCs are not typically considered to be hands-on, especially if really early stage. But I think our experience has been like the opposite of that, actually. We have very close relationships with the VCs that sit on our cap table. They provide a lot of mentorship, guidance, network connections, help with regulators. Our business is very heavily regulated in the countries where we operate. So I think this is a misconception I can comfortably speak about.
Okay, so far we have vibes people who are not hands-on. All right, moving over to PE.
Well, I think one of the misconceptions that's often out there is that when a PE investor comes in, they will directly or immediately fire the whole senior team and take you out of it, right? But if I look at my own experience, and I've seen a number of deals where we actually were very keen to keep the existing management and founder even in. Sometimes it is as a chairman in the board, right? But often it was also still in a management role. So I think you shouldn't be that scared of a PE firm.
They will not take your jobs. Well, sometimes they do if it's necessary, but not always. Okay. All right. Last but not least.
Yeah, I would say that one of the misconceptions is when you are tech, you should go to a VC, and when you are not tech, it's private equity. Why it's not like that?
Okay. Great. So to get on to the second question, so we've seen a different market that we currently are compared to last year. I think we've all talked about how VCs have started being more cautious. So some might go as far as to say, the VCs are behaving like PEs now. They're paying a lot of attention to the bottom line as well, and we're sort of seeing this convergence. I'd love to get your opinion, Greg, on is this a trend that you've seen in your work? Do you think there is going to be a convergence, and should there be a convergence?
That's it's funny because just before the downturn, we were saying that PE and VCs were swimming in the same lane because PE were basically investing like VCs into tech in bigger rounds, and we saw PE launching VC fund within the PE. So that's, I'm thinking about African Invest or Helios or other. And now, after this downturn, we see something like the revenge of the PE. They wanted to be cool like VCs, and now we see VCs trying to push more on profitability and so on. But still, one of the misconceptions we could have with that conclusion is we are doing the same job. Well, it's not the case at all. We are not taking the same risk. And it's very important to remind everybody that VC is a model, it's a fund model, which rely on the fact that we'll invest into business which can scale very quickly to provide home run to the fund, and because we invest on risky business which are innovative. And PE, it's provide fuel to business which are much more understood. And so it's not the same risky, it's not the same fund model. And we need to be careful as VCs not to behave like PE. We need to continue to fund innovation because it's vital for the ecosystem. And I think that we have many things to learn from PE.
Awesome. And then, Martin, so you're coming from the vantage point of one investing in both VCs and PEs as well as having a PE background. What, in your opinion, do you see as the key difference between a PE fund and a VC fund, more so when you're making an investment decision on where to put your money?
Well, what I see as a big difference between PE and VC is that, PE often likes to be in control of the company, right? So when we, in our co-investments, we see that often. We go for 60, 80% or even 100% of the cap table. So that's a big one, I think, which is very different from sitting in a VC firm where you sit with a whole host of shareholders at the table, which often leads to governance problems. So that's a big difference, I think, between PE and VC.
And do you hold them to the same standards? If you look at how you do your due diligence on both of them, do you hold them to the same standards, or what elements are you testing for each?
Yeah, if you're talking about firms, PE firms versus VC firms, and how we assess them, I think we do hold them to the same standards to a large extent. We do expect alignment both on downside and upside. We expect a strong team out there, a team that is also local and able to be hands-on if need be. So in that sense, I don't see a lot of difference.
Great. And Haki, so you have had experience in VC investing in your company. So we can talk a lot of VCs can give their perspective on what they do for businesses. But could you tell us, what would you say is the greatest value that you've seen VCs add to you? I know you're now heading up to raise a Series B investment and you're expanding into new markets. How would you say the VCs have contributed to your journey so far?
If I may just change the question a little bit, our shareholder base, actually, we have VCs and we also have DFIs, like FMO. And generally, our shareholder base has been very, very supportive. Again, as I had said before, we've received a lot of support from, so our VCs are actually more, they have more local experience, where we sit in Jordan, for example, and they've been very helpful with giving us the needed support for expanding our network there with local banks, where we obviously need to raise lots of local debt, and also with the network that they have with the regulator and the relationships and all that. That has been immensely helpful to get the business off the ground. And then with the DFIs, the support that we've had is the focus on the stamp that we get from, the being impact and impact focused and DFI approved is very solid. And then the relationship that DFIs have beyond just the local market in other markets as well. So we've received a lot of help expanding into Egypt because of the shareholder base and the relationships that the DFIs hold in multiple countries.
Interesting. So are you also then saying that at this stage of growth, you still do need investors that are local and can provide that local value addition?
Yeah, absolutely. So while we're now about to start raising our Series B, we're looking for investors who match the stage that we're at. So I would say I don't want to rule out VCs per se, but our investors, the future investors that will inject capital in our company, definitely need to have local experience in Egypt. They need to also be patient investors and understand that we're not a business that is will grow at all costs. This is a very sensitive business with very small room for error. Portfolio quality is very important, so we need investors that sort of match this kind of focus that we have for the future.
All right. And then Ola, so you're in VC, right? Where do you see the overlay between VC and PE? Say, is it in terms of exits? Do you work with PE at all? Where do you see that overlay?
So I actually have an article on my LinkedIn. It's called The Private Equitalization of VC. And it's talking about this sort of increasing overlap between venture capital and private equity. And a lot of people would still argue that VC is just a sub sort of group or a sub, almost like a type of private equity, and they're not so separate after all. So where I see the sort of overlays, what's happening with like Verod Keppel, for instance, where VCs are leaning on the back offices of established VC firms for operational experience, for example. I also see in the later rounds, PEs coming in. So there's a Nigerian fintech called Interswitch. They never had any VC investment. It was all from private equity firms. So I think the first firm that invested in them was Leapfrog, which was private equity. And then they also had investment, I think, from Helios as well, which was at that time hadn't launched their venture capital company, so it was a private equity investment. So a lot of the companies that actually have strong fundamentals seem to just go straight to raising VC, and that allows them to take more money off the table than if they were raising traditional VC. So that's where I kind of see the overlap, and I think that more and more we're going to continue to see the lines blurred between PE and VC, because you see PE firms that want to sort of give their return profile a little bit of a, or give their investors a bit more flavor in terms of what you would typically see from a PE firm is probably, 6x, 8x return, and that's pretty good if you see that. Whereas you can see a bit higher. So for like people that want a more diversified portfolio, they'd say, okay, we can do a little bit of PE with the fund, and then some of it will go to VC. And I think VCs as well, as you go up the rounds, they become more private equitalized. I've just written a book called Journey to Series A. And by the time you're getting to Series A and Series B, you've given away like half of your company usually, or like 40-30%. Then it starts looking the stronger governments, the stronger controls, etc. It starts looking a lot like a PE controlled firm with a minority stake. And by that time, a lot of the small VCs, the seed VCs, the angels are out, and you really have sort of more private equity type investors with a lot more control running the companies, and a lot more sacking founders as well. Sorry. No, post Series A and Series B, you see investors being a lot more aggressive than you see in the earlier rounds. So I think that those lines will continue to blur, and we'll be seeing a lot more mixed firms, not just because of what we want to do as investors, but because what our LPs want. We're seeing the need for diversification in portfolios is becoming, stronger, a stronger voice from LPs, and people have to develop different skill sets to be able to bring about those kind of returns that the LPs want to see.
Fantastic. And I know that, Greg, you have a strong opinion on that distinction again between VC and PE in terms of innovation versus more traditional-led businesses. what do you think about looking at the bottom line as far as VCs goes? Because, you know, there's the first stage of growth where you're looking at top line, not bottom line, and sometimes breaking even too early can even be a disadvantage to a company. So I'd love to get your thoughts on, as far as that conversation, PE versus VCs go, do you think it's a right way to go for a VC to start looking more and more at the bottom line?
I think it's a very good news for the VC industry that that this industry lands, and the narrative around the growth went too far, and we saw things which were not, I think, relevant on the market. The fact that you can acquire customers which won't never be paid back, it should be a red flag for anybody. But we were in a situation where we had something like a Ponzi scheme, and so we had to play that before the downturn. We had to play that game, supporting startup to get a certain market share, whatever is the cost, which was very dangerous for the industry. And I think the landing is it seems to be okay. It's not a fall, it's a landing. And the fundamentals are coming back. And at the end, if there is no business delivering cash and without any capacity to be at some point in the capacity to decide to make an arbitrage between growth and profitability, it's dangerous. And this is what we are learning now, is how do you manage to combine the necessity to deliver growth, but whenever you need, you can decide to stop or to reduce the path, the speed, and be break even. And that's why I think we need to be very focused as a VC to be able to always have a plan B in case there is no more cash. And this is how we will be able to build a stronger ecosystem. But again, a VC model is based on the fact that you need to have to deliver value with a portfolio which 80% of which could fail. Otherwise, we won't have anybody able to invest on innovation. And so we need to be very careful. There is a VC industry which objective is to finance innovation. It's not because you have tech that you are innovative. And again, there are many startups coming to VCs which are not relevant to VCs. And that's important when you are an entrepreneur to ask yourself, are you building a quite traditional business, marketplace, for instance, and you should go and meet some small PE funds, for instance, or more traditional investors, or are you building a very innovative, risky business and a big market, and so you should pitch VCs.
Okay, great. And Martin, honing in on that break-even point, since you're looking at direct investments also in VC and PE, right? At what point do you draw the line and say, okay, this business needs to break even and start making some money? At what stage do you look at that?
Yeah, I think for us, the point that we start looking at as a PE type of investment is indeed when it's profitable, right? You want to see sub-track record, at least a positive EBITDA. That's a key thing. And that's not only because you want to have that certainty, it's also because that allows you to actually borrow money, right, from the banks, which is also a feature that PE typically brings in. So that's, I think, an important piece of it, why we make that distinction at that point. Governance is sometimes also a clear consideration. How many shareholders are there at the table? Can you actually take that control that you want? And just also to the point of Greg is, PE, VC firms do have a high tolerance for failure, which PE firms do not have, because the model is completely different. As a PE fund, you invest in 8 companies, and you cannot, have one of them failing, because it basically will eat all your carried interest away. So that's why there's this insistence on, investing in good companies that already have a track record.
Yeah. Great. So, Haki, it must be interesting for you to sit down and hear VC say, oh, this number of companies can fail when you're a company, and obviously you don't want to be in the number of companies that fail, right? So I guess for you, this question on exits is always on the owners of the PE and the VC to figure out how they're going to make their money. But from a founders or entrepreneur perspective, what do you think about the exit options on who you would like to exit the business to? Or is this something that, is going to be figured out in the future?
I would say that I think, we're currently in the stage of raising Series B, where we expect to be profitable at the end of the year. So we still have a bit of time where we expect to fundraise before, we exit. Ultimately, I think our business model fits either a larger fintech that would like to add our business to their portfolio, or a bank that wants to expand into SME, something that is tech-enabled like Liwa. But I wouldn't rule out PE. Our model, once we hit profitability and the scale of growth that we're at and the sort of maturity we've reached in the company, we would also be possibly, could get funding from PE and ultimately exiting to a PE. I wouldn't rule it out, honestly.
Okay. All right, and I'll ask the last question to you. So given you're essentially fundraising from the same people that are investing in the PE funds, are there things that you find that, you're required to have that you think, well, no, that's probably not applicable for me as a VC, that's more of a PE thing? Are there any frustrations you find in the market, maybe on your side or in other VCs that, we're talking to the same investors, but the standards are different, they should not be the same?
Really interesting question. I think it's not just a PE-VC thing. I think that limited partners have a whole variety of options. As a high net worth individual or as an institution, you can choose to invest in the bond market. It's great now, risk-free return of 5%. It's like free money. So why would you then allocate to a riskier asset class? You have public stocks, for instance, very good opportunities in the public markets right now. The pricing is probably reaching the bottom, so there's fantastic opportunities for growth. And if you look at the past few weeks, the money that people have made in Facebook, Amazon, businesses with track record, businesses with huge cash flows, that's an option that the institutions can invest in with a lot more, that can invest in easily, that can invest large amounts of money, and can do that without the anxiety of having to trust new and emerging fund managers in an unstable market with devaluing currencies and and small market sizes. So I think, I don't feel like I'm in necessarily having issues with convincing investors around private equity, but it's around the other asset classes that they could be allocating to now. And that's why I think as VC, we need to really think quite carefully about how we can deliver alpha, because right now we're not doing that. There's quite a few. My first fund that I raised in 2008 delivered a 25% IRR, which is like a top quintile fund anywhere in the world. But now I'm raising a bigger fund, and I'm always thinking about, can I do that again? But that's what investors want to see, because they're not only taking the VC risk, they're actually taking Africa risk as well. Whereas if you invest in a Berkshire Hathaway bond, it's 4% and it's Warren Buffett's. So it's almost like you're getting the money for free. So I think, a serious conversation needs to be had around how we can continue delivering these above market, true alpha type returns that we're promising in VC. And that means paying attention to the fundamentals. That means issues of governance as well. And that certainly also means perhaps in Africa looking at other ways of getting liquidity. So when companies are approaching profitability, for example, looking at dividends as a form of liquidity, giving some money back to investors to say at least there's something coming in before that 10-year point when we'll have the exit. But definitely, yeah, going back to the original question, I don't think it's a matter of PE or VC. Both have not done well in Africa compared to other asset classes. I think it's about how we as fund managers can really deliver on our promise of giving that alpha back to LPs. It's not philanthropy.
Absolutely. Great, thank you. We'll open it up to questions from the audience, or, if the audience has answers also to some of the questions raised, like delivering alpha returns to LPs. But do you have any questions from the audience?
Thanks for still being here.
Yeah.
More directed to the PE side, or the what do you think is the current perspective of the LP market on what's happening in Africa? Returns, as Ola mentioned, not really showing superior anything at this point. Is it an impact play, largely funded by DFIs, but will it look like the VC in other markets, or is it going to become something else specific to Africa?
Look, I cannot give a forward-looking answer on this. I don't know, simply. I mean, what we did see, of course, is that 2015, Africa was on the cover of The Economist. And in 2019, when I went to a conference, I only met other DFIs there. So all the US tourists had left again. It was a clear signal, right? And I think that's something that we as investors in Africa should keep in mind, that we have to still convince other LPs, more commercial LPs, that Africa is a good place to be investing in. It also requires discipline on our side, that we make sure that we focus on governance and ENS standards. So that's also something that we need to bring more forcefully, I think. That's the only way we can make it an attractive asset class, because in the end that will deliver the returns that commercial investors want to see. But I think to date, indeed, commercial investors will say, well, the return I get in Africa doesn't really fit the risk that I'm taking there. So.
Any further questions from the crowd? I think you can wrap up.
All right. Thank you very much. Thank you.
Please help me give it up for our panelists. What a fantastic conversation to end up the day. One final piece for today's agenda, which is going to be two fantastic startup. Do you want me to take a picture of you guys?
Yes.
Yeah. The selfie was cute also.
My arms are